Hello, this is Michael Joyce with Agili, and I'm pleased to share with you our thoughts and viewpoints for the winter of 2020. Now, we just finished a blockbuster year in 2019. Returns were great, and we were really hitting on all cylinders. Every major asset class was up for the year. And a lot of it was because we've had a resiliently strong economy here in the United States. Unemployment is still at a 50-year low. There's real wage increases that are going on in the economy, which means that workers are getting wage increases that are about 1% over the rate of inflation. And all of this has occurred in a time frame where inflation has been pretty muted. And that's unusual. In past times when unemployment gets very low, it's a situation where wages go up, and that tends to be inflationary. But that hasn't happened this time. So we've had kind of a Goldilocks period for the economy, where the economy has been reasonably strong, but yet inflation has been muted during that period. Now, the markets advanced strongly even in the face of some headwinds that we like to call the three T's, trade, tariffs, and tweets. And where that was felt most acutely in the second half of 2019 anyway was in business investment. You know, business investment tailed off a little bit in the second half, and I think that's pretty understandable. I mean, if I was the CEO of a big multinational company, I would want some certainty with trade policy before I was committing to a big capital expenditure project. But the slowdown in business investment was more than made up for by the consumer. Consumer spending has been very strong. And remember, consumer spending makes up about 2/3 of the U.S. economic growth. So that's a very important measure. Also, small business has been pretty strong. I mean, when I talk to community bankers and ask them about small business loan demand, they say it's very strong. They say the biggest issue facing small businessmen is a shortage of labor. You know, they can't find the workers to do some of the to do the work that needs to get done for all the work that they have coming in. We've also seen a little bit of a slowdown in other places in the world, like Europe and in the emerging markets. I mean, Europe is still facing the issue of Brexit, you know, and it's kind of like a slow-moving train crash, you know, because the original Brexit vote was done all the way back in 2016, and they still haven't pulled the trigger on it, you know, so that's caused some slowness in the economy there. And in the emerging markets, that's really been impacted by a lot of the trade issues that has occurred over the past couple of years. So where we are right now is, you know, we still don't think that there's a recession that's imminent, probably. As the head of the Federal Reserve Bank in Richmond said last week at a luncheon that I was at, he said that business cycles never die of old age, but they die of heart attacks, which means that usually there's some, you know, major macro event or some exogenous event that precipitates a recession. So we're looking at the markets and saying that they're, you know, priced a little bit high right now. So we're pruning a lot of positions that have done very well and have reached their full pricing, their full valuations at this point in time. We're staying diversified, and we're being a little bit careful at this point in time. Now, in the new year, it's also a time that a lot of people make New Year's resolutions, and everybody should make financial resolutions every year. And the biggest thing that you can do at this time of year is to take a look at your written goals and objectives. And yes, I said written, because you should have these written down so you know what your objectives are, and take stock in how you're doing in working towards achieving these long-term goals and objectives. And a big piece of this is savings goals. You know, so it's a great time of year to take a look at how much you're allocating to your 401k plan, to your 403b plan, and other qualified retirement plans, and make adjustments. You know, so if you find that you're a little deficient in that area, what I would suggest doing is maybe increase it a little bit, maybe increase it by 1%. If that doesn't hurt too much, keep increasing it in little intervals, maybe 1% at a time, and keep increasing it until it starts to hurt a little bit. And then you know you're going to be on better track to reach your financial goals and objectives. There's also a great time of year to look at something that people rarely think about until they have to pay the bills, and that's your property and casualty insurances. You know, these are the types of insurances like your homeowner's insurance, like auto insurance, like your umbrella personal liability insurance, and take a look at those to see if you have the right coverage, whether you're paying too much or too little. It's a good time to shop that around. And if you need some help with this, your financial strategist at Agili is more than happy to assist you with this. So I'd encourage you to contact your financial strategist. So I've been very pleased to share with you our thoughts and viewpoints for winter 2020. If you have any questions, you can contact me or contact your financial strategist at Agili. We do put a lot of our insights on our website, agilipersonalcfo.com, and you can also see that on Twitter. Thank you very much for watching.